Good morning and welcome to Money Control live stream. You're watching markets with Santo and CJ, but today it is minus CJ and
that's RT.
Yes, it is Reema Tendulkar. I was wondering how to fill that extra airtime today, and thankfully my colleague tech editor Reema Tendulkar has agreed to fill in for CJ. And given that TCS will be announcing its first quarter numbers later in the evening today, I thought who better than Reema to fill that slot. Reema, thank you so much for joining in at short notice.
No, it's absolutely my pleasure, and I'm very excited. I think this is my first live offering with Money Control. So I'm very excited, and it's not just TCS, right? This week, a whole host of IT companies, large caps. So we've got TCS today. On Wednesday, we've got HCL and Wipro. On Thursday, we've got Infosys, and throw in a couple of mid caps like Mindtree and Cyient and L&T Infotech, which reports on Saturday. So the focus is going to be on IT this week, large caps and mid caps.
So Reema, you'll be coming here more often because CJ is anyway not here till Thursday. That's what he said.
I'm not committing on live television.
Okay, no problem. Okay, so let's quickly begin with a look around the world, and the jobs report which came out in the US on Friday, that's come as a big dampener for bulls because the reading, that's about 2,63,000 jobs added. It's certainly not good news, which means that the labor market is still very tight, which in turn means that the Fed will continue with its policy of increasing interest rates, and some fear that it will continue to do so till it does not break something in the capital markets, and that's bad news for emerging markets, India included. Now, a lot of people have been bullish on India, the big reason being that growth rates, earnings growth, and also the macro situation is much better compared to the developed world. But at the same time, some market experts have cautioned that still you've got valuations being slightly on the higher side. And remember, you've got the rupee also under pressure. A quick look at the market setup, the trade setup before I toss a few questions over to Reema. Now, the Dow Jones fell about 600 points on Friday, and the Nasdaq was down about 3%. So mayhem in US markets, and that's expected to spill over to the Indian markets as well. And according to the early SGX Nifty reading, Indian markets are set for a bearish start, and in most probability that could continue through the day. Now, 17,000 is the key support level that most 17,000 and 16,800 are the key support levels that most technical analysts are looking at. Whether those numbers will hold, whether those levels will hold, we'll have to wait and watch. Okay, Reema, let's get started with the stocks that are on our watch list this morning, and I'll begin with TCS. Now, ever since the first quarter numbers, you've seen IT services stocks underperform. The management commentary was positive at the time of the first quarter numbers as well. And if you see analyst reports, again, there doesn't seem to be any major change. And yet you have the street bearish on IT. Now, why is that so?
Well, it's largely because of the big PE de-rating that we've seen. So the IT stocks, on an average, we're using the representative of Nifty IT, that's down 30% from its peak levels, okay, from its lifetime high levels. Now, about 25% of that is on account of a PE de-rating, a PE reset lower because of the higher cost of liquidity due to the Fed rate hikes that we've seen globally. The earnings downgrades up until now have only been to the tune of about low to mid single digits, and that's largely because of margin pressures. Because the in terms of the costs, they are mounting. Attrition has lingered on longer than what most analysts had anticipated. Everyone thought that things would ease up by the second half of this calendar year. It's not. Attrition is still at elevated levels. Fresh hiring, continues to boom. So in that context, what the street misread at the beginning of the year was the extent of margin pressure. So there has been some decline in margins, right? In the case of, I think, Wipro, HCL Tech, they were all at decadal low margins. I think HCL Tech lifetime low, Wipro was at a 10-year low, or I'm reversing the two. But anyway, margins have been extremely weak for IT companies, right? And that's driven about a 3 to 5% decline in EPS. What the worry is now that next year, 2023 is going to be weak on the top line as well. Sometime typically in January, budgets are set by the large enterprise clients. Okay, we know what's happening with Credit Suisse, right? There are worries. If it's happening in Credit Suisse, maybe it happens with the rest of the BFSI sector. Roughly about 25 to 30% of IT companies' revenues comes in from the UK and the European region. There, things are slowing down. Retail is another big sector. Between BFSI and retail, about 45 to 50% of the IT companies' revenues come in. We know what happened with Walmart, Target. All of them are now saying that we're stuck with high inventory. They're cutting down profit estimates. So what the street is worried is that next year, when the budgets are going to be set, things will turn south on the demand side. The tech budgets will be cut, and that will hurt the revenue. So margin pressures stay, and there could be a nick on the top line. And that's why the street has started pricing in. They're worried about what next year's growth is going to look like. This quarter is going to be good because this is a reflection of the order wins that you've had. I won great orders 1 year ago, 2 years ago, and I'm going to be executing that. And therefore, this revenue is going to look good. The worry is what happens next year.
Now, specifically on TCS,
Yeah.
what is the market expecting?
Well, they're expecting a constant currency revenue growth, which is similar to last quarter. As I said, revenue is going to be intact for most IT companies. In terms of margin recovery, it's going to be fairly muted. So typically, Q1 has wage hikes for, say, a company like TCS, right? So Q1 margins go down. In Q2, they bounce back, and they bounce back by, say, 200 basis points, right? You just exclude the margin impact, and Q2 margins bounce back. But this time, the margin expansion for a company like TCS is expected to be limited, 70 basis points. And for many others, like Wipro had delayed its wage hikes because of, again, pressures on profitability. So Wipro's wage hikes come under pressure. For Infy as well, they staggered it. So in Q1, they gave hikes to the junior employees. This quarter, they're giving hikes to the senior employees. So even Infy's margin gains are going to be limited, say 20, 30 basis points, nothing significant. So revenue growth strong, similar to Q1. Margins will improve because Q1 was a bump, like it bombed out. And then you had the rupee depreciation aiding the margins. So it will improve, but again, not too much.
And what about the attrition levels? That's been the major worry for most IT companies. Yeah. Are we seeing any signs of easing on that front? At least the IT companies now seem to be getting a little strict with their employees. You had Wipro coming down hard on moonlighters. Variable pays have been held back for many employees. Yeah. So all these things. So what is the trend on that side, on the hiring part and the talent part?
So attrition, what we've gathered when we speak to people in the industry, is at levels similar to the last 1 or 2 quarters. Maybe a marginal decline in one company, a marginal uptick, but there is no broad drop-off in attrition levels. Hiring is going to be crucial because most hiring plans are decided at the beginning of the fiscal year, in April to June. Now there are reports about how some companies are delaying the onboarding of freshers. So they're not saying that we're not going to hire you. They're just saying that instead of probably starting in September, come in December, right? They're delaying the fresher. So commentary on the supply side, especially in terms of variable costs, as you said, and fresher hiring is going to be very important because of the kind of reports that have surfaced in the last 2-3 months.
Now, if you look at many of the analyst reports, they still seem to say the same thing, that we are not seeing any major demand slowdown.
Yes.
And at the same time, the market seems to be very skeptical. Now, do you hold the argument that no matter what, even if there's a slowdown in US now, tech is something like essential spending, and so it can't slow down at all. And so there is every reason to be bullish on IT stocks. Do you agree to that theory?
Well, IT could be the last place where we will see spending cuts, right? So if the recession is very mild in the US and Europe, then perhaps IT companies can get away. But if the recession deepens more than what the companies right now expect, then there is no way that tech budgets do not get cut. So it really depends on the way the global markets play out and the extent of recession. But as you pointed out, digital transformation is essential, and therefore there is a high likelihood that tech budgets will be the last to get cut.
Now, in terms of positioning, the market seems to be more positive on some of the mid-cap stocks. At least that is what I gathered reading through most reports. What is your take there? Who's in a better position at this point in time if there is a slowdown, the larger companies or the smaller companies?
So typically the history tells us that in recessionary times, large companies fare better. There are reasons for that. One, they have a very diversified offering of services compared to mid-caps who have a niche. Like one company is stronger in retail, like Mindtree is stronger in retail, L&T Infotech is stronger in BFSI. So they have very niche offerings. Typically, a TCS Infy have a diversified offering of services which holds up well. So even if one lever goes down, the other one can fire and keep the, broadly the revenues are intact. So typically history tells us large caps do well. The reason why the street was more optimistic, and there's another reason actually, mid-cap companies in IT have a greater dependence on few clients. Again, because it's the whole diversified argument of large caps. So if that one company doesn't do well, and a lot of them have that, even Persistent gets, like close to 15-20% of most of the mid-cap company revenues come in from 1 to large clients. So if they don't do well, then they get hit. So which is why history tells us large caps fare better. Their cash management is a lot better, their receivables are stronger, etc. This time, why the street is a little more bullish on mid caps, because the Q1 numbers, mid caps fared far better than the large caps. The growth rates for the last 2 or 3 years have been much stronger for mid caps versus large caps. So there is a recency bias in the market that because mid caps have done well, outperformed large caps over the last 2 or 3 years, that may continue in the future. And this time, mid caps are positioned better. You know what, the other factor which helps if we have the time, mid caps, is that if I had a 100 rupee budget, I'm bringing it down. I'm making it 80 rupees now, right? There is a budget cut. What I may choose to do as a client is that break this up and give, instead of giving an 80 rupee deal to a TCS or Infi, I may say I will give it to 4 IT companies, small, focus on the exact nature of return that I'm expecting. So I may give 20 to you, 20 to another mid-cap, 20 to mid-cap A, 20 to mid-cap B, 20 to mid-cap 3, 20 to mid-cap. So deals also start getting smaller when things get tight, because the companies, the enterprises want a very focused return, what their expectation. So that could help, mid caps.
Okay, and with that we move on to the stocks on our focus. Now, I've been always negative on the IT sector here, but my colleague CJ is always been quite bullish, and his argument, had he been here, he would have said that there's no slowdown in demand yet. At least you're not seeing that from the commentary of companies, and also that the margins of IT companies
have bottomed out in Q1.
Yes, in Q1, and that would have been his argument. The next stock, Bandhan Bank. Now, the second quarter update from the bank was quite disappointing almost on every count. Loan book has been flat for the first half of FY23. The CASA ratio has fallen by almost 2.5 percentage points to about 40 odd %, and the share of retail deposits has also come down very sharply from about 74.1% versus 79.3% last quarter. I've been bearish on the stock, but had CJ been here, this would have been his typical argument. He would have said that, well, Bandhan Bank has also been underperforming to a large extent. Maybe the negatives would have already been priced into the stock. CEAT is the third stock on our watch list this morning. Now, good recovery in CV space augurs well for CEAT, considering that 45% of its revenues come from the commercial vehicle segment. Besides that, the most important thing is that rubber prices have come off very sharply, almost 34% decline compared to the average for the first quarter. Besides, crude prices also have been falling down, have been coming off. So these two could possibly lift CEAT's margins to about 12 to 14% according to Money Control Pro. Now the current margins are around 8%. So fall in raw material prices, also the fact that the outlook for the CV segment is positive, and yes, the company is also trying to step up its presence in two-wheelers, cars and the off-road segment, where the margins are much better. Now, had my colleague CJ been here, he's got this habit of contradicting everything that I say. So his main argument would have been that the semiconductor shortage is still on, and that in turn could pressure not just auto companies but also auto ancillary companies. And again, wholesale sales are much better than retail sales at this point, and the stock may be discounting all positives given that it has gone up sharply. Well, with that, the market has opened. Nifty is down about 200 points in early trade, but still above the psychological 17,000 mark. That's a big positive. Nifty Bank is up, and you're still no, today you're not seeing much of interest in second line stocks. They are as much under pressure as the front line. 1,500 stocks down on the NSE, and 534 stocks are up at this point in time. Nifty mid cap is down by about 1%. So you're seeing some kind of a broad-based selling across the board. Next stock on our watch list is Sumitomo Chemicals. Now, huge portfolio of specialty products there, and besides, the parent Sumitomo Chemical Company's innovation track record has been quite impressive. Now, Sumitomo Chemicals has been trying to being very aggressive on new product launches. It launched close to about 4 products in the first quarter. It's got in principle approval for 5 more products and planning to invest about 120 crore in it. And besides, there's an export trigger as well, because its parent Sumitomo Chemical as well as group companies are looking to outsource more from other countries than China, and this is where it would be beneficial for Sumitomo Chemicals India. Again, CJ's argument, he would have said that volume sales are still an issue because of the deficiency in paddy sowing. So, that is clearly one cause of concerns, and also the stock is fairly expensive at these levels. It is quoting at about 43 times FY24 estimated earnings according to Moneycontrol Pro. Last stock on our watch list, Greenply Industries. Now, demand for plywood has been quite weak and demand has almost collapsed in Europe. That is a big negative for Greenply Industries because its Gabon operations which were turning around, now that is likely to come under pressure because of all the problems in Europe. Now, what CJ would have said, he said that the company still has a leadership position in the plywood segment, and most importantly, it is now planning to plans for the medium density fiber operation, they are pretty much on track. Trials are expected to start in the 4th quarter of this year, and commercial production could start from the 1st quarter of next year. Besides, at about 15.5 times FY24 earnings, the stock looks pretty reasonably valued. Well, Reema, thanks for pitching in.
Thank you for having me.
Yeah, and those insights were quite good, and I'm sure our readers would have also appreciated that. And with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and I'll be back again at 3 p.m. Please do post your feedback in the comment section below.